Today I'm going to show you why the stock market is overvalued, and I'm going to offer some solutions other than to not buy at the current price. So if we look at the 10-year price-earnings ratio, now the price-earnings ratio is a measure of valuation. The higher the number, the more overvalued it is. If we go back to 2000, it was listed here under strongly overvalued. And if we look at currently, it's almost up to that level. We also had a brief period in 2020 after the COVID lockdowns because companies were losing money, and so the number spikes up. But this doesn't really count here. But this number is up in the strongly overvalued category. Also, if we look at the Shiller price-earnings ratio, this is a price-earnings ratio average over 10 years. Back during the dot-com bubble, it was 44. Now it's 38. If we go back to 1930, it was 31, so it's higher than what it was in 1930. Here's another one that I found interesting. Federal debt as a percentage of GDP, 99.6% federal debt now. That's about as high as it was in 1945 almost. And it's not just the U.S. stock market that's overvalued. If we look at the price of gold and U.S. dollars here, it's, as you can see from this chart, it was about $1,800 per ounce. Now it's roughly $3,500 per ounce. It's not just U.S. dollars. If we say, okay, the U.S. dollar is devalued, that's why it's so overpriced. But let's look at other currencies. If we look at currencies such as the euro, it's pretty much more of the same. You can also look at the British pound, same deal pretty much, same kind of chart. Japanese yen, the same. You go basically, here's another one, Mexico peso, more of the same. Maybe it's just all of these currencies have lost value, or maybe it's that gold is also increased in value and is sort of overvalued. I tend to lean towards gold being overpriced and the stock market being overpriced rather than just to look at all currencies as being devalued. It's not just U.S. stocks, gold, but also U.S. residential properties. If we look here at the residential property chart, as you can see from this chart, it's record high territory now. If we look at the price earnings ratio for the Vanguard total stock market, this is thousands of stocks, basically the entire stock market in the US. If we look at the price earnings ratio for the Vanguard total stock market, this is 3,500 stocks and represents pretty much all traded US stocks in the US. The price earnings ratio now is 26. That's really, really high. That's for all stocks. That's the average. And it goes even higher when we look at tech stocks. If we look at the Vanguard Information Technology ETF, VGT, this is the chart that I use for the thumbnail, and this is tech stocks. If we look at VGT, the price earnings ratio is even higher. The price earnings ratio for VGT is a very high 39. That's really high. When we look at some of the individual stocks that make up VGT, such as NVIDIA, which has very strong growth, has a price earnings ratio of 58. If we look at Microsoft has a price earnings ratio of 38. It's been at roughly 30 for the longest time, and now it's at 38. Even Apple has a price earnings ratio of 35. I think Warren Buffett sold it when it was in the 20s. And we look at Palantir. Palantir has a price earnings ratio of 571. So as you can see, the price earnings ratio for tech stocks is even higher. If you believe the US stock market is overvalued, one solution is just simply not to buy or to wait for prices to go down. But another option is to look for alternatives. With all this high inflation, I think a lot of people are they're getting used to looking for substitutes. If one product is overpriced, such as food, they can easily switch to another product. That's sort of what I'm doing in this video. So if we look at the price earnings ratio for the US, the darker the color, the more overvalued it is. If you look at the lighter colors, it's a lower price earnings ratio. So China's at 11, Indonesia 11, the Philippines 9.75, Japan 16. So I started to look at this website, Global PE, and you can see the US here, 27, a price earnings ratio of roughly 27 for the total stock market ETF. Only one is higher, and that's New Zealand. That's 32. If we go down, Switzerland is lower, 21, Sweden, Australia. And as we go down, it gets even lower. So the lowest is Colombia at 9, the Philippines 9.75, Brazil 9.97, And they've done a price earnings ratio evaluation for 5 years, 10 years, and 20 years. And they list whether it's expensive, whether it's undervalued or overvalued. So for example, most of these say for US, it says expensive, expensive, expensive. For a lot of these, it says overvalued. As we start going to the bottom of the list, it says undervalued because they're below their average over a period of time. The Philippines shows cheap and undervalued. Brazil. So what I'm going to do today is these are actually ETFs. This website actually took these countries, found ETFs for these countries, and so you could actually buy these ETFs. So I've taken all these ETFs and I put them in, and I'm going to compare the performance. This is the total return. This is dividends included and reinvested. If we look here in purple, this is the Vanguard S&P 500 index. This is the 10-year return for all of these, 268%. So it's kind of blown all these other ones away. The next nearest one was only 81%. So if we look here and you read the labels, if you read the labels in this legend box, Vanguard VOO 268%. The next highest one was EWY, which is South Korea, 81%. EWJ, which is Japan, 81%. And then you've got EWZ, which is Brazil. By the way, Brazil has a 50% tariff right now that Trump has imposed. It has the highest tariff out of all of these. The lowest tariff is for Chile. Chile is ECH, 28%. Chile hasn't done so well, even though it has a low tariff rate right now. And one of the most surprising, I expected the Philippines, I was hoping it would have done better, but EPHE, the blue one at the bottom, minus 20%. So if you would have invested in the Philippines, these various stocks, I think there's 32 in here, you would have lost 20%, plus you would have lost money to inflation, and that doesn't include all the ADR fees and the withholding taxes for the dividends. Let's switch to the 5-year now. When we switch to the 5-year, it looks a little bit better for some of these. If we look at EWW, that's Mexico, the Mexico ETF, 107%. It's actually beat the S&P 500 at 106%. And it's been going strong since about January of 2024. As I understand, there's a lot of manufacturing that's moving to Mexico. It doesn't look like the ETF's been too much impacted by that so far. For Colombia, I selected a different ETF because the one I put in that they had in the list wasn't working. So I'm using COLO. It had a 72% return, which is the next highest. And if we look at one of the worst performers is China. All the way from 2021 to currently, it was down almost 50% at one point. Also, Indonesia didn't do very well at all. Indonesia, after this 5-year period, returned only about 12%. So not very good for Indonesia. And they have almost 300 million people in Indonesia. Now, another one that was sort of touch and go that was losing money for this period was EWY, South Korea. So South Korea had kind of a bumpy 5-year period. It's up 21% at the end of 5 years. So not a huge return. Also, if we look, we see this blue line here, EPHE, that's the Philippines ETF. It only did roughly 12% during this period. Now let's look at the 1 year. If we look at the 1 year, the S&P 500 is no longer the top performer. China, FXI, 52% return. The S&P 500 only returned about 21%. Also, the next highest performer is Colombia at 31%. Then ECH, which is Chile, and Chile only has a 10% tariff. It's up there with Colombia, which also has a 10% tariff. Mexico, EWW, has a 25% tariff right now. That's 14% return for the 1 year period. And we see the bottom performer for the 1 year period is Indonesia at minus 7%. If we look at the year to date, EWY, which is South Korea, has a 44% return. Next is Colombia at 36%, then Mexico at 32%, and the S&P 500 for the year-to-date period is almost near the bottom. It's only a 10.75% return, but it's still better than the Philippines and Indonesia. Most of these are iShares, ETFs, and most of these have a high 0.5% expense ratio or higher. And the dividend yields on these are higher than most U.S. stocks. Some of these are up to 4%, 5%. If we look at the top holdings for the Philippines ETF, they have 15% in I believe this is a container company, mostly a lot of industrial stuff. You don't see any sort of tech stuff. And also Jollibee, which is a fast food, a Filipino fast food. And I've looked at the performance on that. It's been pretty much sideways for many, many years. So none of these have actually done very well. And shipping containers is not going to be very good when there's lots of tariffs right now and sort of a trade war. I don't have the info for the Colombia one. We'll look that up later. The Vanguard S&P 500, as you know, is probably mostly tech companies. You've got very fast growing companies like NVIDIA, Microsoft's growing pretty well. Meta has had very impressive growth. If we look at Meta's revenue growth, you've got 19%, 20%, 15%. When we look at the earnings per share growth recently, the last few years, 41%, 60%, 70%. The US market is expensive, but there's a lot of tech and a lot of growth. Now let's look at Brazil, EWZ. It's a new holdings, which I believe is a financial company. You've got Vale, which is a mining company. You've got some, I believe this is petroleum companies. So a lot of industrial type companies. Next, you've got the EWY, iShares South Korea. You've got a lot of tech companies in this. You've got Samsung. You've got Samsung, which everyone's familiar with. SK Hynix, I believe they make RAM chips. Hyundai Motor, Kia. So you've got some tech in this one. Also, iShares Japan ETF. You've got Toyota Motor, Mitsubishi, Sony, Hitachi, Nintendo, SoftBank, Mitsubishi. If we look at Sony, they've had a 18.6% revenue growth one year, 10%, 10%. When we look at their earnings per share growth, 18%, 19%, 14%, 78% one year. With Chile, you've got a lot of financial companies. You've got Banco de Chile. You've got an airlines company. Mexico has the number one holding is a financial company. Then you also have Walmart Mexico. You've got CEMEX, which I believe is a concrete company. And you've got Bimbo Bakeries. You've probably seen their products in the grocery store. Indonesia, surprisingly, has a lot of banks. They've got the top three holdings. The first one is 20%. That's PT Bank. You've got more banks behind that. And you've got the FXI, iShares China Large Cap ETF. China also has a lot of tech. So between all of these, South Korea, Japan, and China, all, I would say, developed economies have a lot of tech companies. So you've got Alibaba, Xiaomi, BYD, Baidu. The growth on some of these is very high. So Tencent Holdings has a price earnings ratio of 24. When we look at the revenue growth, it's got 27% one year, 16%, 11%. When we look at the earnings per share growth, 39% one year, 72%, 40%. But it's up and down a little bit. They've had some declines a little bit, minus 38%. Also, there's Xiaomi. Xiaomi has a price earnings ratio of 41. If we look at the revenue growth for Xiaomi, 39% one year, 35%, 33% another year, 19% another year. When we look at the earnings per share growth, 75, 34, 592. So pretty impressive growth in income for Xiaomi. Some of these, such as Indonesia and the Philippines, had a very low price earnings ratio, but the performance was not very good at all. Some of the performance on these was so bad, I was thinking, why even take the risk? Why would you even invest in that when you could put the money in something like an iShares 0 to 3 month treasury bond ETF and probably get a higher return, or just let it sit in the Fidelity government money market fund and the brokerage account? You would actually have a higher return than those two. For example, this one, let's plug in SGov and see what happens. When we plug in SGov, you can see the solid blue line here. It returned 2.65%. This is the year to date. It's actually returned more than several of these. And if we go back further, if we put in the 1 year, 4.56%, you would have lost 1.04% with Brazil. You would have lost 8.7% with Indonesia. And it was actually down below 20% at one point. Also, South Korea was down halfway through the year, down below 20% at one point. If we go to the 5-year period, SGov returned 15.45%. And this is virtually risk-free. It's, backed by the government treasury bonds. Whereas these other ones, they're way riskier and they're taxed a lot more. There's high fees for the fund. There's currency exchange risks. There's country risk. There's taxes on the dividends that are paid, tax withholding. So I would rather have SGov than several of these. So for the 5-year, for example, China for the 5-year returned less than SGov, which was surprising. And in blue, you can see the Philippines. It's basically treaded water the whole time. You would have actually made more money in SGov than the Philippines. The same goes with South Korea. South Korea, SGov did better than South Korea a large portion of the year. South Korea did worse than SGov for a large portion of the 5-year period. Now, these aren't the only ETFs that you could buy. You could actually buy another ETF that's actually has a much lower expense ratio that invests in the developed ETFs such as South Korea and Japan. If we look at the Vanguard FTSE Pacific ETF, VPL, it has a very low 0.07% expense ratio. It invests in the Asia Pacific. It has 2,300 stocks. Average price earnings ratio is 14.9, 99.4% foreign holdings. We look at the holdings, there's no emerging markets, so it's going to be mostly South Korea and Japan. And when we look at the top holdings, Samsung, and you've got Australian companies, you've got Toyota, Sony, Hitachi, Nintendo. Okay, so let's plug this one in, VPL. VPL did about as well as the Mexico one, EWW. We're looking at the 5-year here. Now, it still didn't do as well as the S&P 500, but if we compare it to the South Korea ETF, EWY, it actually did better than that one. And if we look at EWJ, I think it did slightly better than that one also. So here's EWJ, here's VPL. So very similar performance, and there's a much lower expense ratio. And I believe it's more diversified also. So why would you want to invest in these ETFs when the performance has been worse than the S&P 500 until just recently? As I've shown you, the S&P 500 and US stocks are very pricey right now. Now, the great thing about US stocks is there's a lot of tech and there's a lot of growth, but the price is historically very high and the price could drop. Also, we've got trade wars going on with a lot of countries. So the US may be at a disadvantage right now for a lot of products. And so some of these countries that are not doing trade wars, they may be at a more competitive advantage because if countries that are looking to buy products don't have a high tariff rate, then they may look to buy from those countries instead of the US because they'll be cheaper. A lot of these countries have a higher inflation rate than the US. I didn't put in Argentina, but you can see it's got a lower inflation rate now, 39%, but it's been very high. 2023, it was 200%, 94% the year before. If we look at Brazil, it's running at 5.35%, which is higher than the posted rate for the US. If we go to the US, it's showing 2.7% inflation rate. Now, maybe you don't believe these, but I'm just looking at what's posted here. Back a few years ago, it was up as high as 6.4%. So some of these, Mexico had an inflation rate back several years ago, 7.8%, which is higher than the US. So some of these have a higher inflation rate, and they have currency risk, and they may have special taxes, and they may have higher fees. So that's the downside of investing in these companies instead of just investing in US companies. If we look at the withholding tax rate, this is the tax rate that typically gets taken out on dividend payments. So even if you're at a lower tax rate than this, these dividends are going to be withheld, and then you have to make it up at the end of the year. You have to report it on your taxes. So, for example, it's showing here Chile has a 35% withholding rate. Some countries have a 0% withholding rate. Mexico has a 10% withholding rate. Vietnam, 0. So it varies, but this is another downside of investing in foreign ADRs. One of the pros I see investing in the Mexico ETF is that a lot of the deportations in the US, if we look at this chart here, it's showing that in the US, the number of unauthorized immigrants, Mexico is the largest, 5.2 million. So if a lot of these people are going back to Mexico, they're probably going to boost the economy a little bit, because once these people go back and get resituated, they're going to have to buy products and services, get themselves reestablished. That typically helps the economy. We saw that in Georgia. A lot of people fleeing Russia that settled in Georgia, it actually boosted the economy, and rental rates went up. The economy was booming for a while. But I think there's another option. If you want to invest money and don't want to invest in the very pricey S&P 500 or the total stock market, and you don't want to invest in, and you don't want to deal with the complexity and the risk of investing in ADRs and dealing with that complexity of another country, there's also the Vanguard Value ETF. This has a very low 0.04% expense ratio. You can invest in the US, but at a lower cost. The Value ETF has 323 stocks. It's got a price earnings ratio of 19.6, which is much lower than the total stock market, which has a price earnings ratio of 27. And if we look at the portfolio breakdown, it's only 7% tech, which is much less than the total stock market index, which is a huge percent tech. And you've got a lot more financials. And when you look at the dividend yield, 2.17, that's higher than the total stock market index. Some of the companies in this index, you've got JP Morgan, 3.6%, Berkshire Hathaway, Exxon, Walmart. There's one tech. You've got Oracle, Johnson & Johnson, Home Depot, Bank of America. And let's put this one in and see where the performance is. Okay, let's look at the 10-year for VTV. The VTV 10-year, it's up there with the S&P 500. It did 177% versus 267% for the S&P 500, but it did better than all the other ones. So you've got the low expense ratio. You don't have any of the currency risk. You don't have the inflation risk outside of what's in the country. When we look at the 5-year, okay, VTV was 90%, the S&P 500 was 106%, and the Mexico one was slightly better than that. So very close to the S&P 500, but probably at a much lower risk level if you're looking at the price earnings ratio. When we go to the 1 year, VTV 11.67%, the S&P 500 20.15%. So still a pretty decent return for the 1 year period. And when we do the year to date, it's very, very close to the S&P 500. The year to date, 7.81, the S&P 500, 10.75. So that's another option as well. So I hope you like this video. If you like this video, please make sure to like and subscribe, and feel free to check out some of my other videos or comment below. Have a good one.